So you've been wanting to research companies, but you don't necessarily have the time to do it yourself, or you don't know how to do it yourself. In this series of videos, I'm going to be going step by step through my entire process from beginning to end on how I find companies, what I look for when I do my initial research on the companies, if they pass my initial research, how do I value and evaluate them after reading their financial statement. I will go step by step, including valuations when we get to that point, and how to evaluate companies. My name is Jason Rivera, and welcome to Value Investing Journey Case Studies. Hey, Jason here. Today's case study video, we're going to cover Fanuc Corp. Hopefully I'm pronouncing that correctly. F-A-N-U-Y as the ticker. It's a Japanese company. Before I get to that, though, I need to let you know that you can get this video as audio in a podcast anywhere in the world for free on all major podcasting platforms in the I Love Value Investing podcast and you can get this on iTunes, Stitcher, SoundCloud, Anchor. You can get this as a podcast anywhere in the world. Okay. So a couple of weeks ago, I started showing you some of the companies, or a company, that I'd done my full preliminary analysis on. Dassault Systems, ADR. French company. This one's a Japanese company. In these case study videos, we're going to cover, if you missed the last video, we're going to cover real-world companies that I've researched. I'm going to tell you why they made my list. Usually it's because they have fantastic margins. And also why I'm not going to be investing in them at this time. Usually because of valuation. We'll talk about all that below or in this video. But here is my actual preliminary analysis worksheet. Again, if you want this preliminary analysis worksheet, you can get this for free below by signing up below. I use this worksheet to analyze 3,943 companies' stocks in 40 days in 73 different countries. It'll help you evaluate companies faster, more efficiently, and allow you to find better investments as well, because you'll be researching or getting rid of crap companies faster. Okay, so that link should be below this. So let's get, again, hopefully I'm pronouncing this correctly, Fanuc Corp. Large company. Decent dividend. Again, these are mainly just for reference here. These aren't hugely important to me. This thing of note here, though, is that this company's already got up by about $6 billion in value since I analyzed this company on 4/11, and it's now 5/26. So in about a month and a half, this company's gone up in value by about $6 billion. At least, let me rephrase that. Not gone up in value. Its price has gone up because price and value are two different things, but its price has gone up by about $6 billion in about a month and a half as the markets have continued to rise for whatever reason in the face of this coronavirus pandemic we're still dealing with. Okay. Very good operating margin. I look for anything above 10% on a consistent basis. And this year, it's 18.6. Over the 5-year period, it's 32.2. So this is a potential major concern for me when I see this. I would want to know if I was going to research this company further, which again I'm not. And I'll tell you why below. But if I was going to research this company further, I would want to know why there's such a huge drop in profits in the last year compared to the last 5 years on average. There's a massive drop. It's almost by half. It's probably, off the top of my head, 40%-ish drop in operating profit. That is a massive drop. I would need to know why that was if I was going to research this company further. They bought back some shares. And I'm going to go through this pretty quick. If you want the kind of full explanation of what all these terms mean, why they're important, why they're on the list, there are multiple different meanings. I have training videos for this. They should be either linked below this or check on the YouTube channel as well. Book value per share rose. Again, kind of a very basic valuation. Typically, you want to see this rising unless it's due to goodwill and tangible assets. Most of the time, that's not good. Again, I have a link video below this, or I have a video about this that you can watch below this for more information and context on that. ROIC, again, meets my threshold, above 10% on a consistent basis. This one's more consistent here. So there's not a huge drop off in ROIC in the 5-year period compared to the last year. Again, this illustrates I would need to figure out why there's a huge drop in operating profit compared to, and not a huge drop in ROIC. I would need to figure that out. This is, again, not necessarily a red flag, but it would raise my curiosity if I was going to research the company again. This is interesting. So ROE is pretty much almost 100% of the time higher than ROIC. So this being lower, to me, again, I'm not going to research this company further, but to me means they lost money and they have debt. Why? Or they lost some money in this period, and that they definitely have debt. Why? Because ROE is levered by debt and ROIC is not. So anytime these two numbers are different, ROIC and ROE, if ROE is higher, it means the company has debt. And again, almost 100% of the time, ROE will be either the same as ROIC or it'll be higher. If it's lower, it usually means the company lost some money. And the returns, again here, are negatively levered by debt. So it means there's a low number. Again, I would have to figure this out. But based on previous experience doing this kind of stuff, that is what my guess would be. Again, huge drop in free cash flow. I would need to figure out what these mean. So what these things mean to me, combine these margins, is that in the last year, the company's had some issues, most likely, at least in terms of profitability. Maybe their costs have gone up, maybe their sales have gone down, maybe they've lost some contracts, I don't know. I would have to figure that out because, again, this is a major drop in profitability. And this possibly shows that. So their cash conversion cycle rose by about 13%, largely due to an increase in DIO, or days inventory outstanding. So what does this mean? This means that people are buying their products less, so the inventory is building up. This could be why their profitability is going down. Maybe they're having to discount stuff. Maybe they're having to write some of their inventory down. Maybe they're having to do discounts to suppliers or clients or whatever. This is one sign, or this is one clue as to what may be happening with the company. Sorry. Okay. Again, this is a clue. So I would look further into this. This would be where I would first look if I was going to research this company further to see why their profitability dropped so much. Again, by half. This doesn't account for all of it. This rose by 13% about in 10 years. Their operating margin and free cash flow fell by about half, or in free cash flow case, more than half in 1 year. So this doesn't account for all of it, but it may be one thing. Maybe they have an inventory buildup. That's another thing. That maybe they have an inventory buildup and they're selling off older inventory, and they're not selling any of their new inventory. Again, these are just clues, places to look in their financial reports that you would need to think about and figure out. But here, so up here, company's okay, frankly. Okay. Their margins are very good, but they've fallen a lot over the last 5 years, but in the last year, they've fallen a lot. So I need to figure that out. To this point, it's kind of an okay, but here's where it kind of completely goes off the deep end. So this is why I will not be researching this company anytime in the near future, because of its relative profitability metrics. EV to EBIT, again, I go through full explanations of what these are in other training videos. So watch those. Those should be linked below. I look for any number below 8. This is at 24.2. Again, here I look for anything below 8. This is massive. This company is massively overvalued right now based on its profitability, or its profitability compared to the size of the company. How is that illustrated? With the earnings yield. So if you were to buy, what this means is if you were to buy today, or again, This is even more overvalued now. But on this date, 4/11, if I were to buy at that point in time based on the company's numbers compared to its size, I would only be expected to earn a 4.1% return in the next year. And based on free cash flow, less than 1% return. I'm not fine with either of those, frankly. You may as well have a bank account and just put your money in a bank account, especially here. So this company looks okay on a margin issue, okay, or it meets most of my threshold on the other numbers, but valuation is what kills it. Massively overvalued. Another way to illustrate this is that to be considered cheap, and I'm calculating this right now, based on this metric alone, this company's shares would have to fall by 92%, or its profitability would have to rise at a similar rate without its stock going up for me to consider the company cheap. 92%. That's almost 100%. That would mean almost 100% loss, obviously. 92% loss on the company's stock. This company is massively overvalued. And it looks like it has some possibly inventory issues, possibly sales issues, definitely margin issues, probably costs rising and or revenue falling. Issues that would need to be figured out even if the valuation wasn't insane, which it is. So this company is not as good looking as Dassault Systems that we looked at last week. That's another one that came up on my watch list. And again, on a preliminary basis, it looked sort of okay. And then you get down to the valuation, it's just insane. So this is why you cannot rely just on the numbers. You also have to value the company as well. And again, these are just relative valuations. Normally, I would do, if I'm fully researching this company, I would do more valuations, intrinsic valuations, and more relative valuations. But because this company is so overvalued, it's not even close. I'm not even going to take the time to do those valuations because they would be, even if it's somewhat fairly valued or slightly overvalued, it's still, well, actually, based on these numbers and experience, I can almost guarantee its intrinsic valuations are off the charts too. So these are kind of a good marker, is what I use these for. Decent marker for potentially undervalued or overvalued companies. And this company's not even close. So if you want this worksheet, so you can evaluate stocks faster and find better companies faster, better investments faster, it will be the link below this. You can sign up for free to get the same worksheet. So you can do the same process. If you're watching on YouTube, make sure to like, love, share, subscribe, and hit the notification bell so you're notified anytime we release a new video, and I'm releasing new videos all the time. If you're listening on the podcast, like, love, share, subscribe, comment, all that good stuff, download, and we'd really appreciate a 5-star review as well. The more reviews we have, the more people will be able to find us, and the more people will be able to help with this kind of information, become better value investors. So thanks for watching. If you have any comments on this company, I'd love to hear them in the comments below if you're watching on the blog or reading on the blog as well. And until next time, have a great day. Talk soon. Bye.